Good afternoon, everyone, and thank you for joining us today for update on CECL implementations for community banks, what the regulators want you to do in 2019. We have a very informative program for you today, and we're excited to get started. At this time, I would like to let you know that if at any point during the presentation you have questions, you can feel free to type those into the question box. It's on the right hand of your screen. And when we have time at the end of the presentation, we will get to those if we can. At this point, I'd like to turn the presentation over to Peter Cherpack, who is Ardmore's Executive Vice President and Senior Director of Credit Technology. He has given presentations for numerous organizations, including the American Bankers Association, the Risk Management Association, the Conference for State Bank Supervisors, among others. He's also been published in publications including the RMA Journal, one article of which can be found in the handouts section on your screen, the American Banker, and a great deal of other publications. He's a thought expert in CECL and stress testing, and he's here now. Peter?
Well, thanks, Matt, and thanks to all of you for joining me this afternoon for an update on what's going on with CECL. This is an important issue, and the best practices keep evolving, to be honest. And so I think it's a good idea that CSI banks stay on top of what's going on and try to understand what the regulators' expectations are. Let me introduce, again, Ardmore for those of you who aren't familiar with us. We've been supporting community banks in credit risk management for over 25 years. We're a full-service credit risk management consulting firm. We do loan review. We help banks who are under agreements, as well as revising credit policy consulting. And we help with credit data management and automation. We've been partners with CSI for over 7 years, helping them help their banks with credit and lending issues. Argus Information Systems is the software provider that has partnered with CSI to deliver CECL compliant software. Argus has been around since '97, and they're headquartered in White Plains, New York, and have built a global compliant bank compliance software solutions for over 20 years. So it's really a three-legged stool. CSI, who is obviously hosting your information. Argus, that is a direct connection from CSI to house the data and run the application, which is CECL compliant. And Ardmore, that's my organization. Our job is to keep you up to date on what regulatory expectations are, translate your needs into the product set, and customize the implementation and support you throughout your CECL journey. So the three of us together, a unique partnership of best practices to meet the CECL challenge. So before we get started, we always like to start out with a poll. We like to understand where banks are on their CECL journey. So we greatly appreciate if you would take a look. Matt, if you can bring up the first poll. We're going to just ask you kind of where you are on your CECL journey. And so on the screen now, you should see the poll question. We'd appreciate your feedback. This is really saying, where are you so far? Haven't started yet? Do you have a plan? You're working on a plan? Are you in the process of looking at your data? Are you looking for an automated solution at this point? Are you even past that? Are you looking at the calculations and trying them out? So I know you may have many of these, but we're looking for one that best, the best option for where you are right now. So we'll just keep that open for another couple of seconds, and then we'll close it up and get started. Okay, I think anybody else want to just weigh in? We'd appreciate it. A couple more, looks like we're voting. So I guess we can show you the responses now. Thank you for participating. It looks like about a third of you, the most of you, are still in planning. A good portion of you haven't started doing anything with CECL yet, and a quarter of you are looking at data. So it's pretty widely spread. Banks are in different places on their journey, and so thanks for the input. Let's see if we can get back to the slides. Okay, you should see the slides now. So let's talk about CECL real quick. It's old news now. I think, most banks know what CECL is, but I think it's important that we talk a little bit about what it is to make sure that we're all on the same page here. High-level overview of CECL. It is, again, the current expected credit loss. This is an attempt to be counter-cyclical with the reserve. So CECL was developed to try to give banks the opportunity to make their reserves a strategic action to help them manage risk and really work on issues relating to what they think is going to happen to the portfolio, not just the current model really only allows you to manage your reserves based on what is actually happening in the portfolio at the time. So generally in the last downturn, we know that looking backwards, we were under-reserved going into that depression, and we were over-reserved coming out. So that lag is what we're trying to erase with CECL. And as we'll talk about in a couple of minutes, that is not necessarily what's happening, or what we're seeing in the early returns. But that is the idea. And one of the key components of this, the first is the LOL, which is life of loan in this case, and the idea of projecting losses the entire life of loan and booking them at the time that you book your credit. So that's obviously very different than traditional accounting theory where you get paid and you get your risk at the same time. In this case, you get all your risk up in front. The second important distinction here is the idea of creating a projection, a reasonable, supportable projection of what you think is going to happen in your portfolio and how it's going to react over time. That is for a reasonable, supportable projection period, which the bank can define, which is just one of the very subjective components of this new standard. It's very subjective, and banks are going to be challenged to come up with justification for the choices that they make and the rationale that they use, and we'll talk about that in a little bit. One of the difficulties of this is being able to justify your projections and being able to do that for different asset types, using the data that you have, using pure data, using different methodologies to do that. One of the misconceptions that many banks have is that they'll be able to outsource this completely, like in a turnkey, to a vendor. And we've already talked to numbers of banks who have been disappointed to find out that no matter what vendor you choose, the bank still owns the risk and the bank still owns the process and the justifications. All the vendor can really do for you is run the calculations or help you run the calculations. And then consultants can actually help you make some decisions and understand what the best practices are. So it's a multi-step process, and it usually starts with a credit data assessment, which is something that you can do yourself or something you can use vendors like Ardmore to do, where we actually take a look at what data you've been collecting in CSI and understand how you're collecting it, what opportunities there are to improve it. Also look at potentially adding additional fields. There's a lot of opportunity we find when we do these assessments. Again, it's just something you can do internally, or it's something that you can hire a company to do. But you really need to understand what data you have, what data you need to be CECL compliant, and then what the gaps are so you can address them. That's usually a foundational first step. Without that, you really can't do anything, including the calculations or any of the other pieces of CECL. You also have to deal with historical data, and this can be a challenge, particularly for, in this case, in CSI, the banks that are on the Meridian system, there isn't a lot of archived data. We're going to talk a little bit later on in this presentation about solutions that we have for CSI banks linked directly to CSI's data that can help, including the Meridian and NewPoint banks. You also have to take a look at external economic indicators. One of the things that I think banks believe generally about CECL is that CECL requires you to predict the future, the future of the economy. And that's not strictly true, although obviously economic conditions impact your CECL projections. Actually, what you have to be able to predict is how your portfolio is going to act during certain conditions, not necessarily the conditions themselves. That means you have to really understand your portfolio and have data available to prove your projections and what you believe will happen. Also, because this is, financial reporting, you've got governance, rules and policies and controls that have to be put in place. When we do credit data assessments for our banks, we generally find that there aren't a lot of documentation and controls in place for the loan origination process, the collection and assignment of codes, and there's very little documentation to explain how it works. So that's something that we'll be talking about as well. You have to actually choose the best methodology, and there are several methodologies from which you can choose for each asset type. So what I mean to say is if you have, let's say, 8 call code-based ALLL collective loss pools, you don't necessarily use the same method for each one. It might make more sense to use, for example, one method for loans of which you have a lot of data and another method for loans that you don't, or a method that works better for longer term instruments versus shorter. You also have to do that reasonable supportable projection period and use Q factors to adjust that over time. So the qualitative factors are still there, but they're different now. Now you're using them to not only adjust for current conditions and changes in the portfolio mix, but you have to also use them to justify projections. And of course, the goal is to create an ongoing, valid, controlled process that's repeatable, stable, and auditable. That's really your CECL journey. And again, vendors like Ardmore and Argus can help you, but this is something that you'll have to own. So data is the key, and for those of you who have attended my updates previously, I think you know that we're strong believers that what makes a bank successful in this journey is having information to work with. You need data for life of loan loss history. Obviously, it's going to be a challenge for banks who don't have a lot of historical data archived. The good news for the smaller institutions today is that with the change to 2022 for the smaller institutions to be CECL compliant, that means you have 2019, 2020, 2021, 3 years of good data that you can put together. And generally, you can extrapolate that out. If you have, for example, a 5-year life of loan, 3 years of good data probably is enough to give you the information that you need that's justifiable. So that's good news. But you need to have the data to justify your projections. You need to be able to possibly break your pools from call code into something more credit risk related, and we'll talk about that in a minute. You also have to be able to correlate how your portfolio has performed during economic change. Again, this is a challenge if you don't have a lot of history or a lot of losses, which is true for a lot of the smaller institutions. There are new disclosures in the standard that require data, and there's a lot of controls and documentation that are required. So data is very important. It makes it a lot easier for you to justify what you believe is the correct answer for CECL. Unfortunately, community banks have challenges with data, as we all know. The typical community bank doesn't have a lot of extra resources, so can't, like some of the larger banks, can take one of their analysts out of production and say, go work on CECL. Most smaller community banks don't have resources available to do that. Only the most basic data is being retained by most smaller institutions. We'll talk about specifically some examples of what we've seen when we've been working with our CSI banks, that there isn't a lot of credit risk characteristic data being retained in CSI, even though there are places to put it. We generally advise our banks on best practices in that area. And there's usually not a lot of automation of processes. Everything's done manually. There's no origination systems. There's not a lot of documentation of the process. All of that's going to have to change under CECL. The good news is that there is an understanding with the regulators that smaller banks don't have all these resources in place and that it'll take a while to ramp up. The bad news is that a lot of these things are stacked against smaller institutions because it's typically not how they manage their information. So it kind of puts you behind the 8 ball as we move forward. So that's my summary of CECL. If anyone on the phone wants to know more about it, they can drop me a note at my email address and we can talk. But let's talk about what's new. wanted to, give you an update on what's going on. There have been, in this summer and the beginning of the fall, some new information that's come out. I wanted to bring you up to date on that. The first was the American Bankers Association put out a response to CECL, a kind of a white paper letter, and I wanted to highlight some of their points for you. Thought it was pretty interesting. First being that their recommendation was that CECL not be an instantly phased-in change where you have a hit to the balance sheet on the first year, but to do it over 5 years. So you could gradually shift from your current incurred loss reserve to a CECL reserve. What has come back from that is the concept of a 2-year period is what's been suggested, and it looks like the 2 to 3 year period is what the regulators have suggested, not the 5-year that American bankers want, but at least there's an understanding that a phased-in approach can happen. The other thing that the American Bankers Association pointed out was that the banking industry is healthier than it's ever been. Partially that's because of what's going on in the industry since the downturn and the Dodd-Frank regulations and others. So the real question is, if we're well capitalized, why do we have to add more capital with CECL? I think that's a good question to ask. So what they've asked is for the regulators to do what they call a QIS, or a quantitative impact study. And that study would look at the impact of CECL on a number of areas that is not well fleshed out in their estimation. One of them is, what is the impact of CECL on certain types of credits or assets on long term? So if you have a long term, a 10-year note, life of loan loss is going to be significant. It's going to drive up the cost of producing those kinds of credits. And we don't think that necessarily FASB has thought through how that could impact longer term loans. Also, lower credit quality borrowers are going to be difficult to offer loans to, particularly during a down cycle, because you'll have to put all the losses up front. If the losses look high, you're going to have to pass that on as an increased rate, and some of these borrowers may not be able to actually get loans anymore. The other thing they want studied is this idea of pro-cyclicality versus counter-cyclicality. There is a belief, and studies have shown, that if banks had had perfect foresight during the last downturn, they would have seen what was coming and pulled back. They would have tightened up their underwriting standards. They would have tightened up their lending, and there would have been even worse repercussions on the economy than there were. So it's not really clear whether or not following the CECL rule by taking all the charges up front and anticipating problems, if that doesn't actually make the problems worse for a down cycle. So these are the things that the American Bankers Association is asking FASB to look at. In addition, they would like a second quantitative impact study specifically for community banks. And we're very happy to hear this. I can tell you that I've worked very long and hard with the American Bankers Association to get their attention for smaller institutions. What they understand now, and I'm not taking total credit for this, but they do get the fact that for community banks, smaller institutions, it's very hard to deal with the additional capital burden that, it's much more of a higher impact on a smaller institution. That community banks tend to hold longer term securities, so they're going to be hurt even more, as we just discussed. Because of the lack of data, you're going to have to use less accurate models compared to some of the larger banks. And that doesn't seem really fair, because it may not be as stable as some of the other models. And there's going to be expense items. And they asked the regulator in the spring, they basically said, we don't want you to use spreadsheets to manage all your data. You've got to put it in some secure place. So that is some cost. They also said you probably need to get external data because you won't have enough to do the models properly. That's an additional cost. And also, really, due to the mixed messages that the regulators have been putting out there about having to do anything, or how hard it would be to do anything, we think there needs to be more clarity. So that's really what the American bankers suggested. And they suggested delaying CECL implementation until the studies can be completed. Now, in the Ask the Regulators webinar that was held at the end of July, they did respond and say that for non-public business entities, they are delaying the implementation until 2022. Now, if you're not sure if you're a public business entity or not, you should check with your auditor and make sure, because it's going to have impact. Typically, an SEC filer is a public business entity. A privately held bank or a small financial institution that's not an SEC filer is not a public business entity. When they announced this delay of additional year for the smallest of banks, they also said this does not mean stop. It means you have an extra year to get your data together and get your plan together. They also pointed out that you really need a plan, that you're going to be asked to show your CECL plan in 2019 in your safety and soundness exam. And in that plan, you've got to talk about what you think the impact of CECL is, as well as how it might impact the bank. We've already helped some of our banks who have already signed up for some of our services put this plan together. Right now, it doesn't have to be super specific. We don't want to overpromise or overstate, but it has to show that you have an idea how you're going to get from point A to compliance. Also, in the Ask the Regulators webinar, they specifically addressed smaller and less complex institutions and how they are treated under CECL. They will not define smaller and less complex institution, but their suggestion is if you're doing relatively simple incurred loss ALLL calculations today, you probably can do the same thing under CECL. Then they proceeded to contradict themselves after that, I'm afraid. They said, you can do kind of what you do now, except everything's different. And it just really doesn't help a lot, I hate to say. For example, they talked about pooling. They said, yes, you can use UBPR call report data to help if you don't have a lot of historical information or losses. But they said that that's only to help you now. You really have to get your own data, and we expect you to replace that with your own information over time. So it's a short-term stopgap that you can use to augment your data, but you have to move away from it. And you'll also see that they talk about how your pooling needs to be more credit risk-based than just using call codes. So it's really going to be difficult to get peer data broken out any other way unless you want to go out and buy it, and that's rather expensive. So most community banks really can't afford that. If you do use this external data, then it's expected to use extensive Q factors to modify it, to make it more relevant to your institution. So, and all of those Q factors have to be justified, defined, explained, and backed up with empirical data that explains why you made these decisions that you did and the rationale that you use. Also in that presentation, they talked about this segmentation issue and said that, yes, you can start with call code. That's a good starting place. But the method that you use should be more credit risk-based, meaning that, for example, if you look at one of the new disclosures, it's called a credit quality disclosure. It shows assets broken out by risk rating group, so by pass, substandard, and watch, underneath the asset-based pools. That's the kind of thing they want you to do, but what they're suggesting is you don't have to start that way, but you have to move that way. My concern for my banks and for the banks that are smaller institutions is that they're kind of saying you can set up a CECL calculation that's simple and basic, and then you have to set up another one that is your goal, where you want to end up. So it's kind of meaning you got to do it twice. Our recommendation is to do it the first time as best as you can so that you're more tweaking and refining over time than creating a whole new process as you get more sophisticated with your data and processing. They talked about key risk characteristics that should be considered. Contractual term is important. Obviously, if you're doing life of loan calculations, you need to understand your life of loan. And the more you lump loans together with different terms, the less detail you have to explain how your portfolio is going to perform. Also, they pointed out that if you lump all these loans together, you have to capture all your losses in your calculation. So if you capture, 5 and 7 year loans and there's very few losses, but a couple in the 7 year, you still have to include those in your totals. You can't just drop them off. So you might be better served to break those out into separate groups. And that the risk rating is important. We talked about that. And that you're going to have to adjust a lot of these things using Q factors. So I want to take a moment to just drill into that for a second, because I know that it's a matter of concern for smaller banks who are used to very basic call code type ALLL. So let's talk about pools a little bit. So a pool, you can have many pools or you can have a few large pools. And the question is, what would be the difference? Well, if you have a big pool and in that pool are loans of different risk ratings, different maturities, different data sources even. You might have peer data mixed in. So you have this pool with all this different data coming in. The only way you're going to be able to break it out and to reflect the actual risk in the portfolio is to use a lot of really big Q factors. And the Q factors have to be justified, and they get a lot of scrutiny from the examiners. So while having a large pool might seem like an easier way to go, I would tell you that it's probably going to be harder in the long run because you're going to have to use more qualitative factors and you're going to have to do more justification and narrative to explain the rationale behind them. Alternatively, if you had many small pools, you could actually break these out into different groups, which means you need less Q factors and there'll probably be less regulatory scrutiny because of the fact that these things are broken out much more clearly instead of being all lumped together. So I think this is one of the struggles that banks are having to figure out, do they have to break their pools apart, and what is the advantage or disadvantage of doing so. Some other things that came from Ask the Regulators, the whole idea of what reasonable and supportable forecasts are. There's various discussions of that to this date. The best practices appear to be at least a couple of years are expected to be forecast. So if you think that you'll be able to do a 6-month projection, that's not going to be acceptable. One of the comments in the second bullet was interesting was when they said, if you've got projection information around, let's say it's used in your strategic planning for the bank or your capital planning, and you don't use it in your CECL calculations, that will be looked down on by the regulators. They're saying if there's good, reasonable forecast information available, you're expected to use it. And also, this period is not necessarily locked in when you make it the first time. They want you to constantly review the life of loan projection and determine whether or not it can be adjusted based on information that's available based on the bank's strategy. Also, relating to the change in reserve amounts, there was a comment that actually has been made a couple of times that, hey, it's possible that under CECL you might actually be able to lower your reserves because if you have a lot of short-term securities, if your bulk of your portfolio is renewed regularly, in theory, you wouldn't have long-term losses to calculate. However, the regulators have made it clear that if you come into CECL and lower your reserves, then they're going to look very hard at the rationale you're using and the justification that you have. So while there is a technical theory that you could have less reserves under CECL, the reality is if you do, you better have a whole lot of good backup material proving why this should be. Again, they reiterated there are no target amount for reserves, but I think we know in real practice, if there's a dramatic change in reserves and that is going down, the regulators are going to be extremely concerned. So let's talk a couple other things, and then I want to show you some solutions that we have for CSI institutions to help you with address this problem in an affordable and reasonable manner. Disclosures are key. This is a very, very subjective standard, and so your ability to tell your story and justify your projections and your ALLL calculation is the most important aspect of CECL. So this narrative has to explain what is going on in the portfolio. And what's really different about this, and I want you to think about this, is that today, when you're changing your reserves, let's say you're increasing because of changes in delinquencies, or maybe charge-offs, downgrades, the traditional credit metrics might make you want to change your reserves. That's not how it's going to be under CECL. What's actually going to happen is you're going to be doing your projection of loss at the time the loan is made. So let's say your first quarter in 2022. Then the next quarter, if you want to make a change, it's going to be because you want to change your projection that you had made the previous quarter. So in other words, if you make a CECL projection based on your best guess on what's going to happen in your portfolio, and a couple of quarters later, it turns out it doesn't happen, you can take reserves out, even if you're having increased delinquencies and increased downgrades. So you're actually decoupling traditional credit metrics from the reserve process. The metrics you would traditionally use to justify change aren't as relevant now as justifying whether or not you made the right projection in the first place. So there's a concern in the industry, which I share, which is that small institutions will not really be able to use macroeconomic cycle information because it just won't be that relevant. Your losses are so few and choppy, not necessarily tied to economic change, more likely to an individual borrower's activities or possibly a shift in a local industry. So what are you going to do? I think one of the things we look at is, will you be using other metrics in addition to economic metrics like changes in your underwriting standards? That might be the really more important thing for projecting losses than changes in the national economy or even the local economy. How would you track that, and how do you justify that? Would you use policy exceptions as a metric and say, based on the number of policy exceptions going down, we're going to take reserve out? These are some of the things that we'll be shifting into over time. Not right away, probably, but over time. So here's an example of how things might work. Let's say that in March 2022, all the indications you have is that the multifamily real estate bubble is about to burst, and you're a multifamily lender. You think that delinquencies are going to go up and that you're going to have downgrades. So what are you going to do? Well, logically, you're going to add 50 basis points. You're going to add something to your CRE pool reserve. Now, flash forward to September 2022. It turns out the bubble is shaking, and problems are starting to show, but it's not as bad as you thought it was going to be. So you're getting some delinquencies, you're getting some charge-offs, maybe even a TDR or two, but not the amount that you had originally projected. So what are you going to do? Even if you're getting more delinquencies and it looks like you're getting deterioration of portfolio, you're going to take reserves out because of the fact you over-reserved in the first place based on your projections. And this would be justified according to CECL. So it's a different world. And, we think that it's going to evolve over time as to the best ways to deal with these things. But some of these fundamental concepts are ones that I think banks are now starting to grapple with. We may be getting past the deer in the headlights feeling about the calculations and now starting to think about really how this impacts credit management. So we asked the poll a little earlier about where you are on your CECL journey. Now there really are two very distinct paths. There's non-public business entities and public business entities. 2-year difference is pretty significant on where you should be at this time. So already, regardless of whether you're a public business entity or not, really have to be looking at your data and understanding where your gaps are and really building up your data and fixing it. 2019 is the year to start to do that if you haven't already, because you need to have at least 3 good years of data. You should already have done the data assessment or be doing it this year, 2018, and have a CECL plan in place. In 2019, for the non-PBEs, for the small institutions, is really your year for project management planning and data, addressing data remediation. The larger banks are going into parallel runs in 2019 and looking at the impact on their capital and starting to adjust their capital plans. They're partnering up with vendors or building their own models depending on what resources they have. such that at the end of 2019, they're ready to transition to CECL. Your smaller institutions, because you have that extra time, have time to start testing the models and methods near the end of next year, and possibly look at in 2020 buying or building a model so that you can run parallel in 2021. So this is the view that we have, and that seems to be in line with the regulatory expectations as well. Now, one thing also to think about is, are you going to do a two-step transition? Are you going to do the best that you can with what you have for 2022, and then transition to a more sophisticated model that's more stable and more acceptable to the regulators in, say, 2023? Or are you going to try to go to a way that is more substantial and complicated in the beginning and refine it going forward? These are decisions that you'll have to make. So what solutions are available to community banks who are non-PBEs at this point? We do have banks who have purchased our software solution. It's a turnkey solution, end-to-end. It's the Argus credit portfolio management tool. But we think for most of the smaller institutions, it's better to right-size your expectations for automation around data management today. That's an education. That's really what we think smaller banks need. So we've come up with a solution unique in the industry just for this purpose, and it's called the CECL Bootcamp. It's directly linked to CSI for data. It's got a credit data mart built in that's dedicated to your institution if you subscribe, so that you can start to archive your data and improve it, manage it. And it's supported by Ardmore. We help you with the training, the consulting, and keeping you up to date with the industry. So what's in it? The first thing that you get if you sign up for the boot camp, and it's also what you would get if you sign up for the full software solution, by the way, is the third-party CECL data assessment, where we actually pull a file from CSI. It's automatic. You don't have to worry about any data linkages because we have a direct feed of all the CECL fields we need from CSI. Of course, that doesn't mean all the data is in those fields, and that's something that we identify in the data assessment. We know CSI's data very well. We've worked with CSI for many years. We're very close to understanding it, and I'll show you a little example of that. And what we'll do is give you a report that says, here are the things that we think you need to do. We'll sit down with you on a GoToMeeting conference call and walk through our recommendations and our questions and make suggestions to you as to what you should do to improve your credit data management practices and get ready for CECL. You also get, as I mentioned, a data mart, which is a secure hosted data mart that CSI will automatically feed that will archive over time. So if you sign up, for example, at the beginning of 2019 or the end of 2018, you can start fresh with data. It also will allow us to pick up some historical data if you're a NewPoint client that we can backfill in, because NewPoint does have some archived historical data. So those two things are very important. We think all community banks should be doing this at this point. It's probably more important to do this than it is to do anything else with CECL for a smaller bank in this time. Also included is the peer forum and portal, where you can log in, you can read about what's going on with CECL. It's a repository of white papers, of webinars like this that are pre-recorded, fact sheets, regulatory information. It also is a place you can actually have dialogue with your peers. You can ask questions, you can post observations, you can ask, for example, you can say, I just talked to my auditor and they said I can do this on a spreadsheet, or, you know, what have you heard about regulatory expectations for banks that have no losses, things like that. And you can actually share information back and forth, which is pretty exciting, I think. And of course, we'll continue to do a series of training updates and webinars like this one for bootcamp members and record those as well. So this basically are the four components of the bootcamp, which is the data assessment and roadmap for improvement, the archiving and creating of a data mart for historical purposes, as well as the training update and the forum portal. Let me just take a moment to talk about data, specifically CSI data, and what this credit risk best practice might be. I'm going to give you kind of a little sneak peek at what we do in our credit data assessment. What we do is we address two things: credit portfolio management best practices and CECL readiness. They go hand in hand, and this is something that's very important. And I know smaller institutions really are concerned about doing, dedicating resources to CECL with no real return other than regulatory compliance. This is an opportunity to improve your data management, which is actually a strategic opportunity for the institution as well. So we look at both, not just CECL readiness, but best practices in credit portfolio management as well. We look at your data, your portfolio data. We look at how complete it is, meaning are you filling out all the fields that are available, all the ones that are important and useful? How is it distributed? Do you have massive concentrations where you just have maybe 3 different codes, so there's no real granularity or breakout, or do you have a good distribution across multiple categories? Is it consistent? Are loans consistently coded, or are they sometimes well coded and sometimes not? And are they coherent? Well, does it make sense if you have, for example, a control code of farm and a collateral code of business assets? We look at the largest concentrations and whether or not they seem to hang together. The kinds of data attributes we're looking at within CSI are always these. We look at risk rating. A lot of our banks that we've looked at so far, the dozen or so that have signed up, a lot of them only use risk rating 3 and 1 for cash secure and like 4 or 5 for watch list or problems. If all of your loans are rated 3, it doesn't give you much of an opportunity to prove to regulators how your portfolio performs over time. So we look at how risk ratings are distributed. We look at credit scores. Are you credit scoring your consumer portfolio? And if so, do you do it multiple times? You just do it at the time of origination? How is that being recorded? Is it being stored properly? Is it distributed properly? And some of the borrower financial ratios that CSI offers, most of these banks are not using today because they haven't been that important. Under CECL, they could be important. They could be used as ways to justify your projections. Debt to income ratio for, again, consumers is very helpful, and there is a place for that in CSI. Industry codes can be very helpful, particularly for those of you who have any kind of C&I portfolio. We understand that smaller institutions don't have a lot of granularity, and it doesn't make a lot of sense to create a little pool, a group of loans that's like 5 loans in it. You can't really use that for anything. So you don't want to get too small, but you do want to have as much information as you can, because that gives you the ability to justify what you already know is likely to happen in your portfolio by segment. Loan attributes that you might want to look at would be, are you putting in appraisal values? Are they current? How old are they? In CSI, if you have an appraisal value, you'll get an LTV, so that's a handy metric as well. How you use your control categories. We've worked with many banks already, and we know that this is all over the place. Control category is probably the single most important code in CSI. It not only helps determine regulatory reporting, but it's used for slicing and dicing the portfolio and concentration management. Collateral coding is probably the other most important code. And are these in conflict with each other? Are they being properly managed? What criteria is used to assign these? And who's managing it? Who's looking at this? Also, problem loan indicators. Are you using the trouble code to indicate your TDRs and your individually impaired credits? That would be the best practice, because that way you can actually pull reports to show you that information. Also, it'll be handy doing ALLL because if you're doing this, you're going to need to identify those credits, and it'd be great if you could do it with a code as opposed to manually doing it. Charge-offs as well, obviously. And now, thanks to some of the work we've done with CSI, they've started to make recovery information available for the first time. That's a relatively new thing in Newpoint. So these are really the components that we look at and how we do our assessments. We create a report that looks like this, where we actually go through and write up our findings, comments, show different statistics that we find when we analyze your reports. And then when you get into the portal, you can actually pull your own reports, which to show how you're doing. So basically, the way that it works, we'll do your data assessment. Then from that point on, your data will be securely archived in your Argus Data Mart. You don't have to do anything. It's a direct feed. Then you can also go into the bootcamp portal where you can interact with your peers. You can look at all kinds of information that's the most current information on CECL. And you can also look at your own credit quality reports. What I want to do for 5 minutes now is show you what this looks like. So I'm just going to actually go into, and I'm hoping that this is going to show on my screen. That Matt, who's working with me, will come and tell me if it's not. But what I'm doing is I'm logging into the CECL Bootcamp, which we do have a number of banks on already. So when you go in, you can see that you're brought into the discussion area. You can see across the top, there's discussions, there's resources, there's also categories of information on the side. Depending on how you want to set up this portal, if you're really interested in communicating with your peers or asking questions of executives or managers or experts, you can actually subscribe to discussions and get emails sent to you when there's a new update. You can subscribe to categories here on the right and get emails as well. It can be as involved as you want it to be. So in this case, you can see some discussions here, including some publications I've posted. Example being the letter that was sent by the American Bankers Association. You can actually download that letter. You can comment, you can like or not like. You can do as much as you want and start to build up your reservoir of knowledge and share that with your peers if you choose. You're in no obligation to do so. You can see we had some posts asking about loss history, webinars. Down in the resources, you can see this is where you would find, if you go to your resources, your credit quality reports. I wanted to show you an example of these. These are going to get produced automatically for you every month, your institution. So a data quality report, you can download it directly from the portal. And again, security will make it so that no other bank can see this. Only you will be able to see your reports, and other banks won't be able to see yours. I'm set up as an admin, so I can actually see all of them. But so here in the credit quality report, you can see the first thing that we do is pull out some of these key fields and look at how it's distributed. So here's risk rating for this bank. It says that 9,044 loans are 0 in this bank, and only 89 loans have a risk rating. So we would see that as a problem, and we would point that out. Product type codes are pretty well used here, but here's an example of collateral codes. Here's the code, here's how many loans are coded that way. You can see 26% are 1s, 43% are Js. That's probably not granular enough to really give you much information about the portfolio, but it doesn't mean it's not necessarily correct. But this is something you can pull every month. Here's the call code breakout. And if you want to start becoming more granular in your coding, you'll be able to track your progress over time using reports like this. Industry codes, for example, you can see in this bank, very little of it is coded with industry codes. So that's the distribution. We also have a map unmapped field. These are all the CECL fields and whether or not why they're used. And here are, for example, statistics on how many records have values, non-blank records, how many are blank, and how many of those are 0. So all of that is information you'll get out of the reports. So that's one set. Another set, let me go back. We also look at distribution. So distribution is important because you want to understand where your outliers are. So we provide these on a regular basis as well, where you can actually take a look at trends in your portfolio. And this will be particularly handy, again, if you're going through a process of improving. This is your way you'll be able to track it. So we have, for example, what's the trend of blank values? Is it increasing from previous month or decreasing? And how has it changed? And we go through the different attributes and list whether or not it looks like we're having more or less missing records. We also look at trends in things like balances. How much is it increasing or decreasing from previous months? We even have some high and low end and maximum values for different fields. This would be where if you had something really crazy come in, you'd be able to quickly identify that it's outside the normal mean and maximum. Again, these are tools that you can use. They're automatically archived into the portal and give you the ability to track your performance with data management. There are other resources available, including, like I said, webinars. The actual CECL ASU rule is here, and all the FAQs from the regulators are here. You can store things in your own resources or access all of them. So it's pretty neat. We're hoping to get more banks involved. We think this is the right kind of solution because it doesn't force you to buy software that you're not necessarily going to use. It does give you, however, the expertise that you need and gives you a place to start archiving your data, which is so critical. So let me just wrap up here. We talked about the architecture of the data mart. We actually went through some of these. One of the advantages of getting the boot camp now is not only does it address the data issues, but if you want to upgrade to the full software solution, you can do so incrementally. So in other words, we'll only charge you the difference of what you paid for the boot camp and the software costs. So it kind of builds a path for you to follow your CECL journey, where you start with a boot camp, you get your data assessment, you remediate your data issues, you start building up your archive, and then when you're ready to start actually doing the calculations, you can upgrade to the full software package. So that might not be till 2020 or 2021 even for you. But the advantage is you don't have to buy it until you're ready. And when you're ready, you don't have to convert anything because all the data will be still in the same data mart. Another option that you have is there's no obligation for multiple year contracts unless you want there to be. So you can opt out from using the data mart and the boot camp if you feel that it's not something you really needed to do. So what you can actually do is get your data back. We are obligated for data security purposes to destroy any data that we have in the boot camp. So we just as soon give it back to you. So if you decide, for example, the boot camp isn't giving you much value, or perhaps best practices evolve in 2021 that you don't think you're going to need any software, you'll be able to collect your data and stop your subscription. So we're a pretty flexible solution. Hopefully that's a pretty good description. We're going to do one more poll now for you, and then we'll take a look at some questions. And so Matt's going to open up our other poll. And again, we appreciate your participation. And here it is. The poll is really to ask, what is your next step? Based on where you are in the process, based on what you've just heard in the last 45 minutes or so. I know probably a number of these steps you might be doing multiple of them. We've kind of put them in order so that, for example, if you're building a plan, that would have probably already happened if you were addressing your data issues. And then if you're looking at a third-party solution, that's probably after you've done that. So again, we're looking for just general information about whether or not what you're ready for as your next step. We work closely with our CSI banks. We don't want you to buy things you don't need. We don't want to set your expectations incorrectly, but we also have to be mindful of regulatory expectations. So polls like this are helpful to us because we can understand where you are in the process and where Ardmore can help, because we don't just sell software from Argus. We also help banks with data assessments as a standalone service. We can help you with CECL planning. It's what you need. CSI trusts us and we trust them. We work very well with them, so understanding what their banks want is very helpful. All right, looks like we're about done, so we'll close that and share the results. You can see that about half the banks either are waiting, still continuing to wait to see what happens, or are just starting to build their plan. About a quarter each are addressing data issues or looking for solutions. So that seems to be pretty much in line with where most banks are. So, so to conclude, we're very excited to be working with CSI on these solutions. We're happy to be looked at as trusted providers of information as well as solutions. We're going to continue to have these webinars. Probably, unless there's a major announcement, we're not going to have another one until the end of the year or the beginning of next year. I should mention that our pricing is going to change in 2019. Right now, the boot camp is $6,500 a year. Anybody who signs up for the boot camp in 2018 can guarantee the $6,500 a year price. We are going to be changing our pricing in 2019 simply because we're way below our competition in pricing. And as much as we appreciate that position, my boss always reminds me that we're not a charitable institution. So we are adjusting up. Similarly, if you have interest in seeing the entire solution, the software solution that does the calculations, we can set up a demo for you where we can actually walk you through the entire process. You can reach me through the contact information on the screen, or you can go to your CSI rep who knows how to get in touch with me, and we can set that up for you as well. I noticed there are a couple of questions. We're just about out of time, though. What we'll do is, for those people who did ask questions, I will send you information directly, because I do have your email address if you ask the question. One question I will address real quick is about a comment that CSI does not have a data warehouse for historical risk characteristic data. That is what this solution will give you, and CSI is directly feeding it. So if you are looking for a secure, auditable receptacle for your data, you're not going to keep it on spreadsheets, you want to even add data that's maybe not in CSI, like for example, let's say you do have loan origination data, or you do have your credit score routinely and you want to save that history. This is going to be your data mart. You can use this as a standalone data mart and keep it forever and keep archiving data into it, or you can convert it to software, or you can just dump it out into Excel and use it for your own purposes. If there are other questions, feel free to email me if you'd like to set up a demo, if you'd like copies of the slides. Drop me a note and we'll be happy to share. So thanks again for your time this afternoon. Appreciate it. We appreciate the support of Argus for the software and CSI. Thanks a lot and have a great day.